Today is Tuesday. It's the meeting of the Greater Cincinnati Democrats. And now it's time to be quiet. Thank you very much, ladies and gentlemen. This is noontime today, and I'm so glad you're here. We have lots of seats over here on this side. We have lots of food, and we're glad to have you. Today we're going to be hearing about taxation from UC Professor Stephanie McMahon, and we're really pleased to have you and her today. And we're going to start off with some, oh, there you are. Oh, with children. I love it. I love it. Deb is here. Our young Democrats. Yay, there's Sid, our youngest Democrat, and Sophie. There's Sophie's back here. Hello.
Did Sophie find her badge?
I brought my iPad today for him, just special, or maybe the two of them. Well, there we go. Hope, I would keep on hoping.
Sophie's looking for her badge.
There we go. Sophie has a badge somewhere. Okay, so there we are. So we have some of our younger members, and some of us happen to be older members. But we are all here today, and we're going to hear some wonderful things about taxation. Do not choke, please. And we're going to hear it without slides, and we're going to hear it without all of the things that she would love to have, because we didn't find out until 7 minutes before the 12 o'clock thing. She thought we had all of the equipment ready every week. So we're going to have this wonderful ad hoc presentation, and you're going to be very kind to this woman who has wonderful, wonderful things to show us that are all going to be invisible to us, because we're going to have to imagine all of these taxes we're not going to pay, or we will pay whether we want to or not. So there we go. Some taxes are good. And when I... Okay, and here we go. So, we have announcements today, and the first announcement is from Deb. She's there all ready for Deb.
Hi, and we're going to turn it on. Okay. So thanks to Dave for holding the mic for me, since I'm a little short-handed here. So the Greater Cincinnati Movement is going to have another public meeting. It's not this Sunday, it's the following Sunday. That's Sunday the 16th. And we are hosting Catherine Terser. She's the director of Common Cause Ohio. Ooh. Coming down from Columbus just to see us and to talk to you. It'll be from 3 to 5 p.m. at the Chameleon in Northside. Again, that's Sunday the 16th. And the talk of her speech is how the influence of dark money affects the common good. So this is for everyone. Another nonpartisan organization making the point that this is for everyone. Thanks.
Thank you. Thank you, Deb. The Chameleon, they have great pizza. I myself go in for their non-alcoholic beer, but that's another story. Okay.
Well, I got one. There's free concerts Wednesday at Burnett Woods at the Gazebo at 7 o'clock all summer long. I went last week. They had the bluegrass. So the Gazebo in Burnett Woods, 7 o'clock on Wednesdays. They also, Blue Ash has free concerts all summer geared towards older folks on Tuesday night at 7, right behind the police station there in Blue Ash. And the Free Thinkers meet tomorrow night, 7 o'clock. That's revolving restaurant place. Free Thinkers tomorrow, 7 o'clock at the Radisson.
Just reminding you that next Tuesday night, the 11th, is going to be at Blue Ash. My concert band is going to be playing, my 70-piece concert band, and it'll be my last summer playing. I've been at it 25 years, and every Tuesday, when it gets towards the Flag Day, we play for the Blue Ash outdoor concert. It's a wonderful concert, and we have a special service area where you can bring grandchildren. We love to have grandchildren singing and playing and dancing to our music. Sometimes we even get real dancers. to dance to our music. When we get to some of those jazz numbers, it's really cool. Okay, so next week, here we go. And here we go, Bill Messer.
Just to mention, the concerts Wednesday are sponsored by the Clifton Cultural Arts Center, the ones in Burnett Woods Park. Also, today is the last of 3 public hearings of the Budget and Finance Committee of the City of Cincinnati. If there are things that have been left out of the budget that the city manager put together and were not reinstated by the mayor, or were reinstated by the mayor, or are still in some jeopardy, please go to that. That's at 6 o'clock this evening at the Madcap Theater, 3064 Harrison Avenue. And that's your last chance to have input on the 2019 budget for the city of Cincinnati. And I've already heard from 4 people today. I had no idea that apparently I was on the radio because I was testifying at, was it yesterday's budget? Yeah, it must have been yesterday's budget committee hearing on behalf of Larry Falcon, who's the head of the Office of Environment and Sustainability, whose head is on the chopping block, has been removed. They want to kill his position, which I believe is the beginning of dismantling the entire Office of the Environment and Sustainability. So fight.
Well done, Bill.
Thank you, fight for him. And then a final thing to tell you about, okay. That was interesting. On the 23rd of June, the 4th Sunday, one of the organizations I serve on the board of called Vegan Earth is presenting Michelle Dillingham discussing local politics, environmental justice, food policy, and more, including a 3rd run for Cincinnati City Council. As you may know, she finished 12th on her first run, 10 on her second run. That's almost exactly the pattern that Roxanne Qualls had. And so she'll probably hopefully she'll get on, she'll have enough visibility and name recognition, she'll get on the 3rd time. The title of the conversation she's having is, excuse me, could you spare a little social change? So once again, it's Sunday, June 23rd. It's the potluck at the Clifton United Methodist Church, which is on Clifton Avenue, 1 block, what's that, north of Ludlow. 2 blocks?
Corner of Senator.
That's true, 2 blocks. 2 blocks. The other block is, the other street is half a block and doesn't go anywhere. But yeah, but it goes to Dewey's, it does go to Dewey's. It's at, the potluck is at, it's our monthly potluck. So the potluck is at 2 o'clock and the program is at 3 o'clock. We'd like people to bring something to eat. It should be vegan because it's called Vegan Earth. And, but if you don't, if you just show up at 3 o'clock to hear Michelle talk, that would be good too. Everybody's welcome whether you're vegan or not. So once again, Sunday, June 23rd, 2 p.m. I'll try to come here some more days and announce that again. I'll give Peter the information. Thank you.
Other announcements? On the vegan front, I have found with very orthodox friends that you bring fresh, uncut fruit. It's always good. Other announcements? Other announcements? Oh, that means we're ready. That's okay. Susan, we are ready for the introduction to our speaker, and you are going to be very patient with our speaker because she's here frustrated because her wonderful presentation to us won't happen. So we're going to have to be very visual in our thinking.
I'm the one who messed up, so throw your darts at me. Okay. I'm pleased to introduce Professor Stephanie McMahon. She teaches courses in tax law and legal history, and her research combines these interest areas. Her scholarship has focused on the historical relationship between taxation and the public's perception of taxation. and from that relationship discovers lessons for improving today's law. In particular, her work has explored how women have been and continue to be affected by taxation and how the government's production of tax guidance has evolved in response to taxpayers' needs. Her writings have been published in top-ranked peer-reviewed journals, student law reviews, and she's in several blogs. One called The Hill and Legally Speaking, Ohio. She's graduated summa cum laude from Oglethorpe University in Atlanta, and cum laude from Harvard, and she has a PhD in American history from the University of Virginia. I'm impressed. And prior to coming into academia, she spent several years practicing in New York in the tax field. So I turn it over to Stephanie.
Thank you.
Is there a button here on the back? Oh, yeah. It's green.
All right. Oh, okay. Please do bear with me. We have slides, and I almost printed out extra copies, but my daughter is very much an environmentalist right now, and so I'm not allowed to print off anything without a 7-year-old's permission. So we're gonna try to make this work. Okay. So being asked to talk about historical tax rates is a boon to someone who teaches tax and has a PhD in history, because not many people are that interested, which is really troubling to those of us who believe that you need to raise revenue if you're going to accomplish anything as a society. So the first thing, though, is figuring out what we talk about, or what we mean when we talk about tax rates. Most of the time, politicians are two ships passing in the night because they're not actually discussing the same thing. So the first thing most people think about is the marginal tax rates. The tax rates that you see in your instructions telling you how much you pay from each dollar. The code looks a little different. The Internal Revenue Code is different. And if this was in a nice large screen, you would see beautifully that we have different red numbers because those are the progressive tax rates. That when we think of our marginal tax rate, we're talking about the taxes that apply to the different fragments of our income, right? Most of the United States federal government's taxes are in fact progressive, or at least to an extent are progressive. And it means, for example, a single person's first dollar is taxed at a 0% rate, and if they have $1 million, that last dollar is going to be taxed currently at a 37% tax rate. When we look at these tax rates, we also can see, I know you can, that we have the imposition of the different tax rates into different tax units, being either a single person, married person filing jointly, married person filing separately, or head of household, that you end up with the marriage penalty and the marriage bonus that we frequently hear about. We hear about it approximately 7 to 10 years, it becomes a new issue. And it's often an issue with an attempt to reduce tax rates. That this is often used in the frame of a marriage penalty as a argument that we should reduce taxes in order to reduce the penalty. The problem is that this penalty creates a bonus at the same time. It just depends upon the relative earnings of different people. So if you have two single people and they each earn relatively equal amounts, they have more income taxed at lower tax brackets, or they have more income taxed in each of their tax brackets if they remain single. So the double the single bracket is larger than the married filing separately. So if you can have two people not get married, then they end up paying less in taxes. I'm originally from Alabama. When you read the congressional record, you can hear all sorts of things about, oh, this is encouraging them to live in sin. Right?
Yay!
So, all right, so as we continue, see, we're gonna go for a few laughs as we go through this, because I know that this is not optimal. So, when we have the marriage penalty, it means those two single people decide to get married, they have more income taxed in a higher tax bracket. It's not just more in absolute dollars, but the effective tax rate, or the top marginal tax rate, goes up. This is not fixed by the marriage filing separately, because the marriage filing separately is just half of the marriage filing jointly rate. So you end up in a system when you have progressive marginal rates that can have unintended consequences. This wasn't created until 1969, when single taxpayers for the first time had some political sway and were able to put a cap to make sure that they, staying single, didn't feel punished compared to joint filers. They didn't think about these, they knew, they were aware that this would happen, but they weren't, it wasn't part of the plan, it wasn't part of the goal to push people into or out of marriage. Well, at least most people think it wasn't. All right. So, when we have these tax rates, for most of this system, you can see with its progressivity, right? But not everything is progressive. So progressive means when you have marginal rates, so different rates apply to different sections of income, the rates are going up over time, but not all are going up depending upon the amount of income. But that's not true for all of our taxes. So, for example, Social Security. Social Security is a classic regressive tax because for the first, as of 2019, $132,900, the tax rate for Social Security, not for Medicare, just Social Security, is 12.4%. Income earned in addition to the $132,900 is taxed at 0%. Because it goes from the 12.4 down to 0, it's regressive. To balance that out though, when they calculate the benefits of Social Security, you do not calculate benefits based on any income in excess of 132, which was seen as a political compromise, right? You're not going to have to pay tax, but you're also not going to get the benefits. You have a regressive tax coupled with a progressive payout structure. So one of the things when we think about tax rates is you need to think about what's happening with the money from tax rates. You can have a progressive tax that can then be used to fund hopefully progressive benefits, but also could form progressive benefits. You could give everything just to the rich people. Or you could have, as many Scandinavian countries do, flat taxes that are then used to pay out a lot of benefits on a very progressive basis, right? A basis that very much targets the poor. So when we think about the marginal tax rates over time, it's the fact that there's different brackets, but that only tells us so much. You need to think not only about what the taxes are, but what the taxes are going to be used. In addition to progressive and in addition to regressive, we also have flat taxes. A lot of states use flat income taxes and certainly sales taxes, so there's no marginal difference at all. All right. The top marginal tax rate, very clear. Can y'all sit here? Oh, you have a much better vision than me. All right. So the top marginal tax rate is the rate that applies to the last dollar earned. This is what a lot of politicians use. Depending upon the amount of taxable income you have, and for everybody in this room, you're probably going to have very different top marginal tax rates. Nevertheless, most polls show that Americans do not actually understand what the top marginal tax rate is and believe the top statutory rate, which is 37%, applies to them personally. Right? So the majority of Americans believe they're paying tax at 37% when less than 1% of the population pays tax at 37%. There's just a classic education problem. People don't know enough of what's going on for them. So despite their marginal application, top marginal tax rates are what's often used by politicians who are trying to cut tax rates. It's the biggest number that you have out there. So if you're a politician who wants to cut taxes, I would be very surprised in this particular room. But if you do, then I would suggest top marginal is what people use. The good thing about marginal rates is this is what you should think about when you're trying to decide whether you want to earn that next dollar. Right? Your marginal tax rate is how much value you are going to get out of another dollar earned versus how much you're going to use for, in this case, for taxes, but it would be the same thing if you had other expenses. All right. The difficulty with top marginal rates is it doesn't really convey clearly how much in overall taxes you're paying, right? Because we have many things like deductions that reduce your taxable income, and because of the progressive rates, you put it together, your tax rates are only a part of what you are going to use to calculate your taxes, and you need to try to put everything in at the same time. So because the top marginal rates, which we'll come back and look at the change over time in a second, you should also think about the number of brackets. I think I had two little things I was trying to make sure I kept it clear, and we're no longer clear. So, because the top rate only applies to a fraction of your income, if you look at your average tax rate, or what tax people call your effective tax rate, that is looking at the average amount of taxes you owe for all of your income. As tax people, like the Joint Committee on Taxation, the Joint Committee on Taxation is the JCT, it's the workforce in Congress for taxes, we always use the gross income. So you take how much taxes you pay, divided by every bit of income you can put in on your tax return to find out what is your average. And the reason we use your average income is to see what amount of your actual income is going to the government. And it highlights the importance of tax deductions. So when accountants talk about their effective tax rate, they tend to use a later number, a post-deduction number. Tax people don't, because tax people want you to see if deductions matter. Okay? So for our effective tax rates, when we are talking about what their effective tax rates, they tend to be, because of the progressive rate structure, a lower number than than your marginal. So your marginal tax rate is going to be a bigger number than your effective, because your effective is average, and therefore politicians tend to use your effective tax rate when they're trying to increase their taxes, because it highlights how many benefits you're actually getting through tax deductions that would otherwise not be seen. So not a politician, when Warren Buffett talks about how his secretary pays more in taxes than he does, he's talking about their effective tax rates. Warren Buffett pays a larger absolute amount of taxes, but the percentage of his income is smaller because she does not have the benefit of all the deductions or the lower capital, or as much income tax as capital gain rate. Okay, so a problem with this though is that a lot of times, usually you can see it, I had good clips where you can see politicians every presidential elections, the candidates will be two ships passing in the night. One side will be talking about top marginal tax rates, we've got to bring it down. The other side will be talking about effective tax rates and how we need to try to rebalance effective tax rates. And unfortunately, it seems that most people do not realize they're talking completely past each other and not actually trying to work to the same idea. If we try to put it together, you can see that it could be that top marginal tax rates do influence behavior, that it may be people don't work an extra hour because of their top marginal tax rates. But if that's the case, most likely, economists will tell us the result should be to reduce the deductions, right? The effective tax rates don't change behavior, only marginal tax rates do. So what we should do is get rid of all the loopholes in the tax system so that people are making more equitable choices with their activities. So, unfortunately, we also know empirically that we don't know much, right? So most studies have shown that people don't necessarily respond to taxes as economists want them to. They've never responded to taxes. Most people, in fact, are simply are making decisions based on things that have nothing to do with the government, either their own sense of desire for a particular job or the prestige if you're a high-income taxpayer, or if you're a low-income taxpayer and you probably don't have that much choice. So regardless of taxpayers' responses, the top marginal tax rate has changed a lot over time and in many ways. So the top marginal tax rates, this is the top marginal tax rate for top marginal tax rate for ordinary income over time. The top marginal rates apply for the ordinary income apply to wages predominantly. They tend to be the country's highest tax rates over time. And sometimes have had many, many tax brackets. So here is a really small little chart of just the number of tax brackets that have changed since 1992. The number have changed. Earlier in time, we had even more brackets. So 1918, we had 56 tax brackets. The goal, though, is it was supposed to reduce the influence of the different tax brackets. People wouldn't try to put income into a lower tax brackets because the gradation between brackets was 1% or 2 percentage points. So it was supposed to reduce the influence of taxes on people's behavior. One theory for the top tax rate, which this is showing you, also generally applies to very few people, which is hard to see from just the top statutory rate. So back in 1918, when they had their 56 rate brackets, the top tax rate was 77%, applying to incomes above $17 million in modern terms, right? So if you adjust it for inflation, the top tax bracket would apply to people earning over 17 million.
Will you show us what the actual graph, since we can't read it, what does the high part of the graph and the low part of the graph mean?
Okay, so here when we started off in 1913, when we first enacted the federal individual income tax rate, the top marginal tax rate was 7%. So and they at the time thought of putting in the constitutional amendment a cap on the income tax at 10%. They did not, because they did not want it to go that high, and they thought if they had a cap, it would just creep on up there. Okay. Then World War I comes, tax rates go up astronomically, at least for the very top earners, getting up to 77%. Post World War I, they go crashing back down. Some people have argued helps fuel those roaring 20s because no money is going to the government to help pay taxes. We go back down to below 30%, about 20, I think it's 24, 26%, much lower tax rate. World War II goes back up. By World War II, you end up with a top marginal tax bracket of 91%.
Now these are for rich people.
This is rich. This is just the very top dollar, and in a little bit I'll show you what incomes this is based on. So it goes. So we have the top tax rate goes up and down. Post World War II, though, it takes a really long time for it to come down. After World War I, tax rates come down. The top tax rate comes down pretty quickly. And then after World War II, it takes a while. The reason why is because during this period, we had more conservative economic theory of trying to balance the budget. So when we tried to balance the budget post-World War II, we're paying for the Marshall Plan, we actually still raised a significant amount of revenue, had relatively high redistribution, keeping tax rates up at 70%, right? People were willing to pay top marginal tax rate of 70%, although there was a lot of tax planning going on trying to stay out of that top bracket. All right. So one of the things that you'll also see is that the tax rates go down. Once they go down, they tend to become what economists will tell you is sticky. Such a beautiful term, right? Once tax rates have got a number, it's very hard politically to change the tax rates. So for 25 years, it bounces between about 35 and 37%, because that's a number that Americans just seem to accept now is what should be the top tax bracket. If we went back up into when it was 70%, people accepted 70%. If you went out today, I'm sure we would have political demonstrations if we tried to go 70% and say, let's just go back 50 years. Okay.
The rich are going to demonstrate? Yeah.
The high rate post-World War II was mostly to pay for the cost of the war, and it was also at a time of unprecedented economic prosperity, as we were the only country in the world that was a major industrial country that was not at ruin. So that's why that kind of tax structure existed.
Definitely, and part of the objective for the high top marginal rate was the perception that certain groups of people, like predominantly large capitalists, had benefited a lot from the demand for war manufacturing in World War II. So there was kind of a we let you have all this earnings, now you need to pay it back. There was also lots of additional taxes, like excess profits taxes, trying to target.
And they benefited from the Marshall Plan too. All that business in Europe, because Europe was rebuilt. There you go.
Can you show us on the map roughly when the Reagan 80s were?
Yeah,
So Reagan is this decline right here, where it goes from the 70s, down to the 28.
Thought so. Thank you.
Yeah. Yes.
So in the 1920s, when you say the tax rate went down, right, and people thought that was the reason for the 120s. If you compare that to the UK, the 1920s was the very first time in history the United Kingdom taxed their upper classes. And they had the same roaring 20s that we did. So why is there that difference when for the first time the wealthiest people were taxed in that country and we dropped? Why do you have the same?
The UK is an unusual system, so I only know a little bit about it. But in the United States, we generally put everything on the same tax return, so everything is basically put in the same income with capital gains giving a favorable rates, and in the last 30 years, everything's got a weird rate. But we generally put it all together. The British system tends to look at things based in different buckets. So even when they started taxing the wealthy, they tended to tax the wealthy's income, but still not their capital to the same extent. So yes, they were taxed more than they had ever been taxed before, but they still, it was not intended to be a redistributive system, at least for their income tax, right? So it's very difficult to say if taxes did have an influence on the 1920s, it was more at the margins, right? It's something where it was just keeping extra cash in the system as opposed to continuing to flow around, as opposed to being a large driver, right? To a certain extent, if the 1920s had kept more of the cash outside of the hands that kept turning it in the market, would have had a greater impact on reducing the spiral. All right, anything else? Okay. All right, yes?
I thought you were going to go into just a little bit of the history of taxation, like in the Middle Ages, with the kings, just a little bit. Because that's kind of fun to talk about.
Have you had a chance to finish your presentation?
No, but no.
Well, so let's just finish.
Okay, I'll get to the Middle Ages in a second. Okay, so we end up in a system with this chart only shows you the top marginal rates, which is only so effective because for many times it doesn't apply to many people. So in the 1930s, when we had the tax rates going up to pay for the Great Depression from 35 to 37, the top marginal tax bracket, which gets up into the 80s, only applied to one person. One person. Good old Rockefeller. So now we don't seem to have that same instinct to be willing to tax one person. So today the top marginal tax bracket applies to about 900,000 households, right? So we're not having a lot of gradation at the top levels of income, which we did in the past. One thing the chart does not show is the effect of where the lower brackets were. So I put this together hoping it would be a little helpful to show the exemption levels, how much income was not intended to be taxed at various times, the tax brackets, the lowest tax brackets for the lower income people, and then the highest. So 1913, when the income tax was adopted, the personal exemption was $3,000 when the average annual income was less than $600. Right? It was clearly not intended to apply to the masses of the people, one of the reasons that it could be so incredibly simple. When it did apply, you had a 1% tax rate, so 1% rate up to $20,000 of income. Gets up to 7%, which is the top marginal rate for people over $500,000. 1918, World War I, brings down the personal exemption. The personal exemption stays pretty low until we get back to the 1990s when we start post-Reagan indexing the exemption to inflation. But even then, we see it takes a really long time to get back to the same nominal amount, right? The first starts off in 1913 as $3,000. That's worth a lot more money than $3,000 in 2005, right? So 1918, we have a 6% is the lowest marginal tax bracket, so it goes from 1% to up to 6% for any income over $4,000, showing that what we did very quickly, whenever there was a war, up until the Middle East, Whenever we had a war, we tended to jack up the rates and push down the levels at which those tax rates applied. So you would apply higher tax rates to lower income taxpayers or to people who are wealthy, but just to a lower threshold of their income. Right. World War II, this is where it became a mass tax, where the income tax really applied to the average person, where people expected to, if they were employed, to file a tax return, partly because the exemption goes down to $500. So you end up with the exemption of $500 for anybody who's got taxable income in excess would have a 23% tax bracket. The lowest marginal tax bracket was 23%, but it goes up to 94% for income over $200,000. So in 1918, the top marginal tax bracket applies to $1 million of income. In World War II, you end up with a 23% bracket for $200,000 of income. Again, pushing it out, trying to raise as much revenue as they can from people at lower tax brackets. So, capital gains is something else that you can see, because capital gains has an unusual history, because capital gains only are the traditional thought of capital gains is it's applying when you sell assets that you held for investment. So you have stock that you sell. Are you going to pay tax on the gain? Originally, in this chart, they didn't start showing it until 1922, because before 1922, the Supreme Court had not even decided whether capital gains would be subject to an income tax. Under the earlier theories before 1921, most thinkers in the United States did not think of gains as being the same thing as income. Income had to be something from your work, from your labor, or your capital generating dividends, as opposed to any appreciation. A distinction a tax nerd really loves, other people may not. Right? So until 1922, people didn't have to report, there was no expectation they would report their capital gains. Once we switched into capital gains, we started pretty much the entire time, but for a very small period during the Reagan era, they've been taxed at preferential rates. They've always been taxed significantly less, sometimes by saying that you're only going to have to report half of your capital gains, and then that half would be reported at ordinary income tax rates. Sometimes saying you would let people choose. You can either report 50% at ordinary rate or have a lower capital gains rate. But so, for example, in 1921, when Congress responded to the Supreme Court saying that would be taxable, the capital gains rate was 12.5%. Congress made it to 12.5%, when ordinary income, so wage labor, was taxed at the top marginal rate of 77%. So ordinary could be at 77, capital tapped out at 12.5. Right? The capital gains has been taxed. Since 1922, capital gains are always taxed. The issue is at what rate are they taxed. The lack of preference during the Reagan era was very short-lived. Everybody who wanted to could see that it was going to be short-lived, because they didn't remove a single capital gains provision from the Internal Revenue Code. The provisions stayed there. They just said they were not going to tax it at a preference. It was going to be taxed at ordinary income tax rate. And as we know, since 1990. We ended up having, or 2003, we had the beginning of the current system with 0% for some capital gains, 15%, and then from 2012 we have it up to 20%. So we've had a bit of a history, but the history of capital gains does not mirror in the same way ordinary income. Ordinary income is more responsive to the demands of war, whereas capital gains are more the result of internal politics. So you see more of changes in political parties, more changes of OPEC, things like that affect capital gains rates more than they do for ordinary income. All right. Other big thing to think about when you're thinking of taxes. So when you think of tax rates, you have to think about, are you talking about marginal? Are you talking about effective? Are you talking about ordinary or capital gains? Or are you talking corporate? Right? So, corporate incomes, right? So, corporate income tax rates, the corporate income tax was enacted before the individual income tax because it was not considered an income tax, despite its label. It was an excise tax on the benefit of being a corporation. So we didn't have to worry about the Supreme Court saying it was going to be unconstitutional, and we had it enacted in 1909 thanks to some senators from Ohio. So we have the corporate income tax. It has a general increase historically in the same way that you would see the individual income tax, so responsive more to war or larger demands for revenue. One of the things, though, that is interesting from a historical perspective is that Congress does not, or tends to not, discuss the tax rates between the individual and the corporate in the same discussion. So when they change the corporate rate, they don't discuss the impact it may have or may not have on the individual rate. So if you're going to cut the individual rate, you may cut the corporate too, just because you're in a general tax cutting, without saying, should they counterbalance each other, should they interact? The discussion of the interaction of the taxes, behavioral economists will tell us human beings are very bad at doing. That most people isolate one tax from another. So in our brains, we'll think, oh, I gotta pay, they take all my Social Security out of my paycheck, or I'm now gonna file my income tax return, and maybe if the corporation's gonna deal with it, I'll talk about international or something else. But in our brains, we keep them all separate. We think of state and local. Whatever we do, we think of it completely different as opposed to a combination. That behavioral economics has done a lot of studies to say that people, all people, including policymakers, have difficulty combining them in people's minds. So the corporate income tax, another thing to see from the corporate income tax, it responds in the same way. More needs for revenue, it tends to go up. But there's a little bit of a catch, because corporations are subject to what is called double taxation. And in this instance, double taxation means the corporation in the United States is taxed as it earns income, right? So it's got its own Section 11 income tax rate, currently 21%. And then when the shareholders or the owners of the corporation receive dividends, they're taxed on the income, or if they sell their shares, it's appreciated, and it's considered a double layer of tax. So at times, when you look at this, when we feel bad for corporations or we're trying to stimulate the economy, then both the political dialogue starts saying how double taxation is bad, right? And then at times when the corporations do something not so good, we start saying, oh no, double taxation is perfectly legitimate because this is actually a separate entity, right? So the discussion is mirrored in a political way and tends to have a how do we feel as a country about corporations affects whether we tax them or not.
Is dividend distribution tax deductible by the corporation?
No.
No. All right. So it is double taxation.
Exactly. And one of the things is corporations can deduct interest pay, or now it's been in 2017 they added a little hiccup, but generally corporations can deduct interest paid but not dividends paid, which is also one of the reasons large corporations have tended to over leverage themselves, taking on too much debt, because of the preference the tax system gives to interest payments as opposed to dividend payments.
Okay, but the dividend payment, that is taxable as income.
It is, although it's now, since 2003, has been taxable at favorable capital gain rates. Before 2003, and I've been a law professor for 10 years, and when I started, I was like, this is going to change back. Now I've given up. But when it used to be, before 2003, dividends were taxed as ordinary income because they were seen as being comparable to wages, right? So you get wages from your work and you get dividends from your corporation. Everything should be taxed at ordinary rates. Since 2003, they're taxed at a preferential rate.
Okay, now to my question. Would that be, yes, there is a question. Would that be mitigated if the corporate dividends were tax deductible to the corporation to resolve the issue?
It would.
Can you repeat the question?
The question was whether if we gave corporations a deduction for the dividends they paid, would that mitigate the problem? It would definitely eliminate double taxation because you would only have one level of tax at the shareholder level. There's lots of pragmatic reasons that would be very difficult, right? Or that it may not necessarily always be equitable. Because if you give them a deduction, then the issue is, should they get a deduction at the shareholder rate, their own tax rate? How is this supposed to be? And then you're you are effectively would be punishing retained earnings because it wouldn't qualify for the deduction. And do we really want corporations to never retain earnings? In other words, it's a slightly nuanced thought about whether we should choose the deduction method if you want to eliminate double taxation. Or if you want to keep double taxation, if you think that corporations are in fact a separate entity. There's one extremely interesting article that says you need the corporate income tax because managers, large corporate managers have gotten such political power that the corporate income tax actually helps mitigate and influence their choices because they're not the workers, they're not the owners. It's just this new group of managers that we need to think about some way of controlling their political and economic influence.
Okay.
All right, so I'm rushing through so you can ask questions.
Stop, please. Let her finish. Let her finish, and then have questions.
Okay. So thank you. Okay, so corporate income tax, we have it over time. One of the things that's interesting about this chart, which I did not produce, is that it has the effective tax rate. The problem is don't trust the effective tax rate. They have a beautiful little picture here, whereas another source says that, oh, no, it was not this high. It was not about 40%. It was actually only 3.4%, right? So one source will say it's almost 50%. One will say it's 2.4%. The reason is that in the United States, for most of our history, but not all of it, we have had taxpayer privacy laws so that you're not able to figure out what an individual person actually pays in tax. For a period, we were able to. So at a time when we did know, so back in 1918, you can figure out how much a person pays because it actually got disclosed. And during the Civil War, they actually would go and post it in post offices so you would know exactly how much your neighbors paid in tax. The top tax rate was 77%, but the effective tax rate was only 15, right? So the average taxes was 15, even though the tax on your last dollar would be 77%, showing there was a tremendous amount of deductions available, as well as a lot of those progressive tax rates, lots of brackets. In the early 1960s, the IRS has estimated that when they had the top rate of up to 91% in the early 1960s, the effective tax rate for people in the 70, 80, and 90% top marginal tax bracket was only 45%. So if you're a politician and you're using a 91% as your political mantra, it's very different than somebody who is responding saying that your average tax rate is only 45. So one of the last things I'm going to show you before, because what I do see here, we've got some good questions, is looking at what the information we have since the IRS now compiled anonymous statistics based on the quintiles. So you can see what the effective tax rates are for these groups. 1979, when they first started compiling this information, for the lowest quintile, the effective tax rate for the individual income tax was a negative 0.2%. Because by 1979, we had the Earned Income Tax Credit, which is the largest form of welfare or income redistribution in the country, goes through the tax system, so we actually take taxes negative, giving them a deduction. The highest quintile was 15.9%, and the top 1% paid 22.6%. So their effective tax rates for this group was 22.6%. 1990 goes down to negative 1.2% for the lowest quintile group. Highest quintile is 14.5%, and the top 1% was at 20%. 2000, negative 6%. So between 1990 and 2000, Congress is increasing the number of benefits and social welfare programs in the tax system to help give people at the lower income spectrum income through the tax system. So when people say, oh, we have 50% of the population are not taxpayers, the reason they're not taxpayers is because Congress is putting things that would have traditionally, or pre-1975, been welfare or other forms of income redistribution, now go through the tax system. So when you're starting to create credits through the tax system, you should expect their numbers to go negative because you're not cutting them a check, you're not giving them housing, you're giving them a tax refund. So at the end, so we go down to negative 6, and now in 2015, the latest for which I can find numbers was negative 11.6%. One of the interesting things, though, is for the highest quintile, the percentage does not change that drastically. It goes from 15.9 down to 14.5. 17.6, and 16.2. Right. Same as for the top 1%, it tends to be pretty static. You should compare, though, the individual income tax versus all taxes. Because when we think about taxes, most people talk about income taxes, whereas payroll taxes are the larger component for low-income taxpayers in particular. Payroll taxes are a very large source of federal revenue. And when we see for all federal taxes, including payroll taxes, we no longer have a negative number because for the lowest quintile, they're paying other taxes. And these are just federal taxes. This is not talking about sales taxes or other taxes they may pay, like indirectly paying property taxes. All right. So, again, hold on. One of the last things to quickly talk about is, again, from the beginning, when we talk about what you owe in taxes, it's your tax rate. All the tax rates we talk about, the different kinds of income, whether marginal or effective, times your taxable income. When we look at the tax rates, like the top statutory, they tend to be sticky. What Congress often does instead is change what goes into taxable income. It's much easier to change a deduction or to give a preference than it is to change a tax rate, because the tax rate is going to be on the front page of the New York Times, and deductions and credits are rarely, although sometimes they are. So for example, again, I'm from Alabama, we like our football, and for a couple of years you could only get a charitable contribution deduction if you bought sports tickets for University of Texas and LSU, something people in my state got very angry about because they just negotiated a perk. There was also a famous perk for Louis B. Mayer of MGM. When he left, they created a tax perk that saved him, at the time, over $2 million in taxes that applied only to him and one other person. All right? We love it dearly. Now we tend to do it a little more broadly. So now our tax expenditures, for example, there's one that was created so that people who write and compose and sell their musical compositions, not their literary compositions, you need to have a musical flourish, but if you do, there's a preferential tax rate that applies to you in Nashville and other areas. They thank their congresspeople and beautiful front page ads, which I show my students to say, this stuff still keeps happening. We keep changing taxable income to favor our preferences. One of the things that Congress has done since the 70s is to keep track to an extent of how much preferences we have with what's called a tax expenditure budget. So you can spend money by giving them tax preferences in the same way as if you wrote them a check. And when you look at the tax preferences, the top 10, the top ones tend to be to apply to higher income taxpayers. So for example, the largest one is the exclusion for contributions to pensions. Not everywhere in the world do they exclude pensions contributions from tax. The fact that we do costs a lot of money. Employer-sponsored health insurance is the second largest tax expenditure. The preferential rate on capital gains is the third largest tax preference, right? All of those come before the earned income tax credit, and the earned income tax credit, again, is the largest form of redistribution we have in this country, and it's the third tax preference.
If you have a job.
If you must, in fact, have earned income. So, at the end of the day, one of the things, though, the last thing I promise I'll stop, is looking at how much tax revenue we've actually raised over time. So when you look at it on this kind of chart, it starts off, we have very little federal revenue, and then it just goes crazy up. The chart, though, which a lot of policymakers will show you, is like, oh, government's going crazy, too much revenue. One of the reasons it doesn't control for is inflation. When we control for inflation, you see, we've grown as a government, but we haven't grown nearly as much, or the amount of tax revenue coming out. In fact, most of the time when you look at it, you can see as a percentage of our GDP, how big our economy is, we're pretty darn flat, right? We used to be at 3%, we used to be at, which way? We used to be at 3%, and now we seem to be tied to approximately 19%. We don't know exactly why we seem to be tied at 19%. Do people respond to taxes and change their behavior? Is this just what the government likes? Who knows, right? But we tend to be relatively flat with GDP. And the one thing that has changed, while we tend to stay at approximately the same amount of GDP, is the percentage of the different taxes. So the composition of taxes within that 19% has changed dramatically. So if you look at it, this one's not, I think, well, this one's all blue, so it's not going to show up very well for you, but if you can try to look, you can see that the colors have changed. We've gone from having a lot of tariffs, a lot of taxes on imported goods, to more of the payroll taxes and income taxes. So if you look at it from this one, we end up having that great big area for Social Security, that great big area for Social Security taxes or the payroll taxes, and the blue are for individual income taxes. Over time, our taxes have changed, not as a percentage of how much the government's receiving, but really from who they are receiving, right? In particular, the payroll taxes, because they are capped at a large amount of income, are coming from workers. They're not coming from the owners of capital, because you don't pay Social Security unless it's tied to your wage labor. So it's just a different change of composition over time. All right, so because I know that there's questions, I'm going to stop and field questions, and I can always go back to medieval if you want me to. Oh, yes.
Testing. Good presentation, thank you.
Thank you.
Could you comment on the relationship or correlation between tax rates and economic indicators that represent quality of life issues like job creation? You know the material.
Wages.
And could you also comment on Elizabeth Warren's tax proposals?
Okay, so the difficulty at this point, I would say, is that we don't have a true understanding of how much taxes actually influence behavior. So most economists will tell you at this point we have a glut of capital. We've got more money that's been saved that can be invested, so that the returns for capital, it's just the returns are low. We've got more capital, so that from a purely economist perspective, it looks like we should be changing the tax versus saving that we currently have, or taxing on savings versus taxing on wages, and flip it back to what it originally was. So originally, one of our most noted secretaries of the Treasury, Andrew Mellon, was one of the 3 richest people of his time, very wealthy man, and he actually said that you should always tax capital higher than wages, because people can't work every day of their lives, but your capital can. So that you need to have people who are earning wages have a lower tax rate so that they're saving money to survive. The difficulty is that when we try to look at this historically, that may be logical, but there's no proof, right? There's no proof that the reason we cut taxes on capital, the argument was that we're doing it to stimulate business. We cannot neither prove it nor disprove it.
Is there a correlation?
Only to the extent that, for example, big picture, World War II, great for the economy, but it was great for the economy with high tax rates, but really had nothing to do with taxes. It had to do with the fact that we had so many people fighting in the military, so we had high employment levels and job creation. So there's no, you could argue, I think it's I think it's something would be purely speculative to try to make a statement. One of the things that we do know, for example, the 2003, when dividends got the preferential tax rate, the argument was this was going to get corporations to pay out all their dividends, right? They're no longer going to have retained earnings, they're going to pay it out. It's going to stimulate economic growth. Almost every study has found that failed, right? That corporations still retained income. The only corporations who made out payments were corporations they wanted to. So,
Elizabeth Warren.
Oh, so Elizabeth Warren, what in particular do you like about it, or dislike?
Actually, I think I think she's put her finger on the problem with the concentration of wealth, and so she's saying take 2% from folks who have 50 million, and that's not income tax, that's an asset tax. And if they have between 50 million and a billion, that's 2%. Over a billion, 3%. And are you in any of those tax brackets?
I work at UC. So at the end of the day, I think her The difficulty with her proposal is to the extent the Supreme Court may determine it's a wealth tax, and if it's a wealth tax, there is an argument that it would not fall within the 16th Amendment. So there is a chance that if you enacted something as straightforward as she's proposed, that it would be held to be unconstitutional. The flip side of that is we have seen since the Affordable Care Act Supreme Court case that courts are very deferential when anything is now, or at least the current court seems to be very deferential. If you label something a tax, they're not nearly as concerned as they used to be. It used to be the court was trying to limit the powers of our taxing powers, and now they're much more willing to let you tax what you want to. So it may be that it's held unconstitutional. Another alternative was what Warren Buffett suggested that would not fix things immediately, or would not lead to redistribution immediately, but would help over time, is if we had the Buffett tax of a flat rate income tax, so that effectively what you would do is get rid of the preferential capital gains rates, so that actually says that when we look at the effective tax rates go up for the 0.01%, so not the top 1%, the top 1% still pays, but the 0.01% has a declining effective tax rate. So we actually do have a regressive effective tax rate for just that very rich people, because less than 20% of their income is ordinary. And if you even use the alternative minimum tax, the AMT doesn't fix the problem because the AMT has preferential capital gains rates. So I personally like the idea of some form of wealth tax. I think there's still constitutional issues that they would have to deal with. I think it would raise revenue and would target. I think that we could also try to do something a little in the income tax realm, which at least would start change without people bringing in the court.
Yeah. The government is currently spending $4.2 trillion a year. It has an income of 3.3 trillion roughly, and a deficit of $900 billion as of 2018. I don't know what 19 is. What would you do to stabilize the government's deficit and reduce it in terms of raising taxes?
Well, I think that the key in order to stabilize the budget is that we would need, in fact, to raise taxes. I think that there's no way that we can continue to spend the way we are. If you look at any study of any behavioral study, people when it comes to trying to limit specific programs, it's very hard to reduce specific programs, very unlikely to actually get reduction. So what we need to do is to raise taxes so that we cannot continue to grow the amount of the debt. Now, I'm not as concerned about the debt as other people may be, as long as the debt stays a relatively stable amount of our GDP, right? As long as our amount of our debt as opposed to how much the size of our economy, as long as the economy can service the debt, we don't actually need the debt to go away. The only time we had 1 year, 1835, we had no debt and we went immediately into a major recession because money was getting stockpiled for taxes in a way that it needed to stay circulating in the economy. So I would say that we just need to contain, and I would say contain by having a more progressive rate structure. 37% is a historical post-1980s phenomenon that I think we cannot do everything we try to do in this world if we're not willing to raise revenue.
Back here is the next question.
So this question is purely out of speculation, but since the income tax was created, it was started so that the rich people could be taxed back when President Taft wanted to bring it in. Do you ever think it would be actually possible for it to fully go back to that way, or does everyone need to be taxed, at least in some way, in this day and age?
So there's the two sides of the coin, right? So one side says that we need every human being to feel the pain of that tax return so that we keep an eye on our government. Except for most of the American population, they don't actually feel that much pain. I mean, they complain about it because we all complain about the tax system, but it's more that they pay someone else to do it, right, that other systems do. So I don't actually think we need a system of getting everyone to pay taxes in order to make them pay attention to government, because I don't think that's worked historically. I do worry that if we try to make this just an upper level or an upper income top quintile type of tax again, and we go away from the mass tax that started in World War II, are we going to raise enough revenue to be able to do what we want to do? One of the alternatives is to move to a higher this would probably not apply in the United States, but we could move to a higher tax, flat tax regime, again like they have in Scandinavia, with then a very redistributive type of payout structure, so that you're actually targeting more income to lower income people, helping them out, creating a greater sense of equality. I think that is more politically viable than just erasing lots of people from the tax rolls, and I think it would just I think it would be more politically palatable in our system.
You'll have a hard time connecting the two.
That is the definite danger, especially in a system where we don't have as much as large of a social safety net.
As far as the deficit is concerned, the amount of debt of a household and the deficit of a country are completely different. They work in completely different ways. And then my next statement is, corporations exist at our good pleasure. This is what people forget. Articles of incorporation are allowed by the society and by the city and the state in which they exist. Okay, the other thing that I want to say is that taxes are a question of fairness. And the rich are always saying they pay more. Well, they pay more in dollars because they make a lot more. And they make a lot more because of this country. And so they owe this country money because, as Bill Gates' father said, take your idea to Somalia and see how much money you can make. The tax structure and the way this society is organized is that people can make a lot of money. And they owe that money back to all of us. And one other statement is, when you say you're taking money from rich people and giving it to poor people, or you're taking money, from people that have higher whatever and giving it to lower people, the question is, if you feel like we're all in this together or not. And the example is, for example, Boy Scouts on a canoe. They're going down the river in a canoe, and when they have to portage, the big guys take the canoe and carry the canoe, the little guys carry the baggage. Is that unfair to the big guys? No, it's not. I'm almost done. Is that unfair to the big guys? No.
You're being unfair to people who have other questions.
I'm almost done. So one aside as the next person gets it, is we have to be slightly careful when we think about corporations as being different, because most American business is now taking place in the form of S corporations, which are pass-through, or LLCs, or something taxable as a partnership. So one of the interesting things from a business tax perspective is corporations are just such a small group of businesses today. Do you want to target corporations as businesses as opposed to other business forms?
I just have a favor to ask. Would it be possible, and I don't know if Peter can do this, if you could give your PowerPoint to Peter, if he could send that out along with the minutes, and that way we could study your charts?
I would be happy to. I can either, or I can send, if somebody gives me an email, I'll email them to you. I can email them to you then. I'll give them to them.
And the last question's over here.
Could you comment about inheritance tax?
So, thank you for calling it an inheritance tax. The death tax. Well, okay, so technically you have two different kinds of taxes, right? So when people die, you can either have them taxed under the estate tax, which is the estate on the tax on the actual estate, or the inheritance tax on the person who receives it. So there's a technical difference between who has to pay, the recipient or the payor. Less than 2% of the American population pays an estate tax at this point in time, right? And this has been true for many decades. Now it's going to be well less than 1%. It is traditionally been seen as a form of not insignificant revenue. As we continue to raise that cap, it's becoming less and less relevant for most people. So personally, I think we need to keep the estate tax. I would also argue, and this is something where I shouldn't do it if it's going to be pushed on the YouTube, but I think we should also get rid of Section 102 that says when you receive an inheritance from someone, you don't have to report it for income tax purposes. Because in my opinion, this is something where I have had a lot of interesting debates with people, is are you entitled to receive the inheritance? Should that be a taxable transaction? I think in a country that needs revenue, taxing people when they receive something from someone else as a gift or largely an inheritance is a time where you can tax without having most of the negative disincentives of other taxes. People hopefully do not die or not based on how much tax they have to pay, right? There was a little blip in 2010. More people died in 2010 than we expected when we didn't have the estate tax. So I would say it's something that's good, and also I think I also think though, based on the planned giving, using and having an estate tax, or especially, is actually tremendously beneficial to business owners and small business owners, because it forces them, their fear of the tax forces them to plan how they're going to transition their business. So a lot of it, I would expect we'll see if in 5 or 10 years, if I'm correct, that without the threat of as much of an estate tax, people are going to have more difficulty convincing themselves as they get older that they need to hand on the reins of their businesses, because they're not going to have the government taking, however they envision it, taking that part of their wealth at the death. And so I think there's going to be a lot less transition planning as we make the tax smaller and smaller. So let's keep it, make it bigger, and actually use it. Let's broadcast it as an opportunity to help businesses transition between generations.
I think Stephanie has done a great job today without all of them. You've really done well. I'm really impressed by how well you did with all of it. And I got some of the, even with the kiddies back there, I mean, I really got some of what you were saying. That's really nice. I think we all have something to learn about taxes. On the other hand, you've done very well today. Thank you so much. And you have been wonderful people. Now, next week, I have to give you a warning. Next week, I want you to be aware of the fact that we are doing Ohio Students for Gun Control. So Marlene, if you have any kiddies that you know of who are interested in gun control, please bring them. And if you have any students who are not in school and they need a luncheon or they need a place to talk about guns and what should be happening with guns, please bring them. We would love to have them here. So wonderful things happening for next week. So please keep that in mind. And the weekend after that is the Freedom Center. Oh. And then we have a surprise. It's going to be a surprise to me too. So it's going to happen. It's going to happen. I'm personally looking for the candidate who's running against the sheriff, McGuffey. Really very interesting.
Oh yeah, Charmaine. Gotta have her. You know about Charmaine.
No.
I'm running for sheriff.
Okay, Stephanie, you've done really well. Thank you. Thank you for